Welcome to the Techno Fundamental Report for March the 5th. Ironically, the key to an emotional discussion is to take the emotion out of it. That's so true about investing. You've got to take the emotion out of it. The market doesn't care about who you are or how you feel about things. It's all about an auction market process and buyers and sellers. So if you get emotional or having your ego involved, that can be a mistake. Now, all of this video and what we do every week is all about trying to help you navigate through the market and to become a better investor. Now, we call it the Techno Fundamental Report because we talk about technical analysis and we also talk about fundamental issues. But one thing I did want to talk a little bit about today is myths. The stock market and investors and the media, they just promote so many myths. I'll tell you some of the myths that I believe are important. One, I think over-diversification. That is, everyone feels like the more you diversify, the safer it is. And it's just exactly the opposite. When you over-diversify, you get spread thin, you're not really paying attention, you become complacent, and it's really not even investing. It's just more or less gambling and guessing. Another market myth is that, the amateur investor feels like he has to be in the market all the time. Well, sometimes you don't need to be in the market. Sometimes it would be better to be on the sidelines, sort of like what we're dealing with now. So there's all kinds of myths. Another myth would be that you can't time the market. That is a myth. You can time the market. Now, we're not talking about prediction timing. We're talking about trend following, which is a great way to understand what's going on. So one of the myths out there is that the more you diversify, the less the risk. Well, Peter Lynch refers to it as diversification. Now, to be honest about it, when he talks about diversification, he's really talking about when a company makes an acquisition of another company outside of its area of expertise. So what he's saying is that the company diversifies its balance sheet because they're bringing on a company that may not fit the mold as well. However, I did want to mention this quote by him, Peter Lynch. There's no use diversifying into unknown companies just for the sake of diversity. Kind of like what Warren Buffett says, know what you're doing, be a know-something investor. A foolish diversity is the hobgoblin of small investors. That said, it isn't safe to own just one stock because in spite of your best efforts, the one you choose might be the victim of unforeseen circumstances. In small portfolios, I'd be comfortable owning between 3 and 10 stocks. This is a great strategy to own and be focused on 3 to 10 stocks because you can, if you're in 3 stocks, you can really get to know those companies. Now realize there are roughly 4,000 publicly traded companies out there, and there's very few that you want to invest in. It's you'd be shocked the studies that I've seen that show how broad diversification can really make things worse. Now, the other thing about diversification too is, and this would be having more to do with index funds. Sometimes they work, sometimes they don't work. So back here in 1950, the blue boxes, the index funds would work perfectly fine. The red boxes, not good at all. In fact, I can remember this period very well. Started in the business in 1976, right in the middle here. The problem was that the Dow hit 1,000 for the first time right around 1968 and did not get back to 1,000 again to around 1982. So if you were in a broadly diversified index fund or really a broadly diversified mutual fund of any kind, you went nowhere for an extended period of time. However, if you would have been finding things like Walmart and Home Depot and McDonald's and Microsoft, etc., you would have done incredibly well. So that would be focus investing versus index investing. So you can see here periods of stagnation, periods of bull markets, stagnation. So you never know when this period is going to attack. However, if you see where we are right now, we're in a very beautiful, nice uptrend. Hopefully it continues to last. Now, the other thing that is happening here with technology is that the stories about AI and so forth are causing certain segments of the technology groups to have trouble. That would be software, for example. So here's a graph doing relative performance of software versus semiconductors since 2006. And you can see that there's been a period of outperformance by software, but it's starting to really fall apart here. So the software stocks continue to look weak. We're pretty much avoiding them. So let's take a look at 5 indexes just to kind of get a total picture of what this market looks like. Here's your NASDAQ. You got your peak. You really got you a double top here. You know, back in late October, we peaked, pretty much moved sideways, peaked again. Now we're in a downtrend on the NASDAQ. Continues to look difficult, actually. So the mid caps, however, are a different story. We're starting to see this market broaden out. So you can see here that the mid caps have basically gone into an uptrend here, stabilizing and holding basically above the moving averages. Whereas if we go back to the NASDAQ, you can see we're below the moving averages and you've got a death cross. Whereas on the mid caps, you're looking pretty good. Now here's the New York Stock Exchange. Now this is generally speaking a lot of defensive type stocks, you know, dividend paying, low PE ratio type things. It's been holding up well because the market has been somewhat defensive. Small caps, just like the mid caps, are holding up pretty well. You can see here that the moving averages are solid. You know, we've got somewhat of a topping action here. But this group looks better than the NASDAQ, I'll say that. And then here's your big old S&P 500. Again, like the NASDAQ, looking kind of weak. So what's happening here is we're seeing a shift, we believe, from large cap Mag 7 type stocks into the other 493 and also small caps and actually growth stocks. Here's the ARK Innovation Fund run by Kathy Wood. It's definitely a risk-on, growthy type of fund. So these are growth stocks, and we're starting to see some improvement here. In fact, we're seeing an uptrend in this fund. You know, the way you define an uptrend, you take the last major event, which is where it made this low. Then we came up, made a high. Now we're making a higher low. And then we're making a higher high. And then we're making a higher low. And we've just made a higher high. So growth stocks actually are starting to show pretty good improvement. Now, if we go to the aggression index, which I feel is a very important indicator, you can see here this is not a good look. I mean, if we go back and look at the last bear market, which was 2022-23, that wasn't a good look. And, you know, you got your moving averages coming down, you know, but you can see here it'll come down, stabilize, and then you'll get a bounce, another drop, stabilization, you'll get a bounce, then you got another drop. So that was basically 3 drops. So you drop 1, 2, 3. Well, basically, if you think about it, we've had, 1, 2. So we may have another one to go. It's just if this time it's different, we don't know. All I can say is that this is not a good look. It's saying to be defensive, don't get too aggressive here. However, the good news is interest rates are starting to come down. Here's your mortgage, your 30-year mortgage, finally under 6% for the first time since 2022. So we're starting to see interest rates stabilize. Here's our power index. Interest rates are basically stable to flat. You can see here on the 5-year Treasury yield, very stable. This is very important. And to be honest with you, I'm surprised interest rates are not higher. Here we have the price of oil. We know we're in a war with Iran. So we got a big spike in the price of oil. As you can definitely see, oil has been in a downtrend. This could be a reversal. So if you have any questions, please let me know. Thank you very much.